Welcome back to my channel, Wealth Waste Tips. In today's video, we unravel the secrets of long-term investing success, exploring 10 proven strategies that stand the test of time. Get ready to pave the way for a wealthier tomorrow. 1. Diversification. Diversification is a fundamental principle in investment strategy that involves spreading your investments across various asset classes and industries to minimize risk. The goal is to avoid overexposure to the performance of any single investment, as different assets may react differently to market conditions. By allocating funds across a mix of stocks, bonds, real estate, and potentially other asset classes, investors create a balanced portfolio that can potentially deliver more stable returns over the long term. This strategy is rooted in the idea that individual investments may be influenced by different economic factors, industry trends, and market cycles. For example, during economic downturns, stocks might experience declines, but bonds or real estate may exhibit more stability or even appreciate. 2. Buy and hold. The buy and hold strategy is a long-term investment approach centered on acquiring shares of fundamentally sound companies and maintaining ownership of those assets for an extended period, often measured in years or even decades. This strategy is grounded in the belief that, over time, the intrinsic value of well-established companies will appreciate, delivering substantial returns. Investors employing this approach focus on the fundamental strength of the companies they invest in, considering factors such as solid financials, competitive advantages, and a history of consistent performance. The buy and hold strategy encourages investors to resist the temptation of frequent trading, which can lead to increased transaction costs and tax implications. 3. Dividend investing. Dividend investing is an investment strategy that places emphasis on selecting stocks from companies that distribute regular dividends to their shareholders. Dividends are a portion of a company's profits paid out to its shareholders, providing a consistent income stream. Investors who adopt this strategy often seek out companies with a history of stable earnings, as dividends are typically tied to a company's profitability. By focusing on dividend-paying stocks, investors aim to generate a steady income from their investments, which can be particularly attractive for those seeking both capital appreciation and regular cash flow. One key advantage of dividend investing lies in the potential for compounding returns. 4. Value investing. Value investing is an investment strategy popularized by legendary investor Benjamin Graham and later refined by Warren Buffett. The core principle of value investing is to identify and invest in stocks that are perceived to be undervalued by the market. Investors employing this strategy typically focus on stocks with strong fundamentals, such as low price-to-earnings ratios, solid earnings growth, and healthy balance sheets. The goal is to find assets trading at a discount to their intrinsic value, representing an opportunity for capital appreciation when the market eventually recognizes the true worth of these companies. In the context of value investing, the emphasis is on the long-term holding of these undervalued stocks. 5. Dollar cost averaging. Dollar cost averaging (DCA) is an investment strategy where an investor allocates a fixed amount of money to an investment at regular intervals, regardless of the asset's price at that time. This approach helps to mitigate the impact of market volatility on investment returns. When prices are high, the fixed investment amount buys fewer units, and when prices are low, it buys more units. Over time, this consistent, disciplined investment strategy can result in a lower average cost per share. Dollar cost averaging reduces the risk of making large, poorly timed investments and allows investors to benefit from the long-term upward trend of the market. Investing in index funds is another strategy that aligns with a long-term passive investment approach. 6. Invest in index funds. Investing in index funds is a passive investment strategy that involves purchasing a fund designed to replicate the performance of a specific market index, such as the S&P 500. The primary advantage of index funds lies in the broad market exposure they offer. By holding a diversified portfolio of securities that mirrors the constituents of a given index, investors gain exposure to a wide range of companies across various sectors. This diversification helps spread risk, reducing the impact of poor performance by any individual stock or sector on the overall portfolio. The simplicity of tracking an entire market index makes index funds an attractive option for investors seeking a straightforward and hands-off approach to investing. One key feature that sets index funds apart is their cost-effectiveness. 7. Reinvest profits. Reinvesting profits, whether in the form of dividends from stocks or interest from bonds, is a strategic approach that harnesses the power of compounding to enhance long-term wealth accumulation. Compounding occurs when the returns generated from an investment are reinvested, generating additional returns on the initial capital, as well as the previously earned returns. This compounding effect creates a snowball effect, where the growth builds upon itself over time. By reinvesting profits, investors not only benefit from the potential appreciation of the original investment, but also from the compounding of returns, resulting in an exponential increase in wealth. The snowball effect of reinvesting profits becomes particularly pronounced in long-term investing. 8. Stay informed. Staying informed is a fundamental aspect of successful investing, as it empowers investors to make informed decisions based on a comprehensive understanding of market dynamics. Monitoring market trends provides valuable insights into the overall economic environment and helps investors anticipate potential shifts in sentiment or conditions that may impact their portfolios. Additionally, keeping abreast of economic indicators such as unemployment rates, inflation, and interest rates allows investors to gauge the health of the broader economy and make strategic adjustments to their investment allocations. This knowledge enables investors to make more informed decisions about when to allocate assets, when to take a more defensive stance, and when to capitalize on emerging opportunities. 9. Risk management. Risk management is a critical aspect of sound investment strategy, emphasizing the importance of understanding one's risk tolerance. Risk tolerance refers to an investor's ability to endure fluctuations in the value of their investments without feeling compelled to make impulsive decisions. It is influenced by various factors, including financial goals, time horizon, and individual comfort with market volatility. To align with their risk tolerance, investors should adopt an investment strategy that balances potential returns with acceptable levels of risk. This involves avoiding investments that could lead to excessive losses and ensuring that the portfolio's risk profile matches the investor's comfort level. 10. Patience and discipline. Patience and discipline are cornerstones of successful long-term investing, emphasizing the importance of maintaining a steadfast commitment to one's investment plan over time. Markets are inherently unpredictable, and short-term fluctuations are a natural part of the investment landscape. Patience involves the ability to withstand the ups and downs of the market without succumbing to emotional reactions. Successful investors understand that achieving meaningful returns often requires waiting for the compounding effect and the growth of fundamentally strong assets to materialize over an extended period. If you enjoyed the video, don't forget to hit the like button, subscribe for more enriching content, and share your thoughts in the comments below.